the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares nudged higher today as all eyes remained on trade tensions between the US and China. So if we look at the Straits Times Index, it inched 0.11% higher to 3,938 points at about 2:15 p.m. Singapore time, with a value turnover of some 542 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended marginally in the green, up 0.05% at 3,936 points. In terms of value turnover, we're looking at 993 million Sing dollars. Gainers outnumbered losers, 291 versus 218. Top advances for today, let's take a look at them. We've got for you Fuji Offset, DBS and DFI Retail Group USD. And top decliners we have here SGX, Jardine Cycle and Carriage, and GMX USD. Now, in terms of companies to watch, we have OCBC because the bank has made a 900 million Sing dollar conditional exit offer at 30 Singapore dollars and 15 cents per share for the 6.28% stake in Great Eastern it does not already own, in a bid to delist the insurer. Now, elsewhere from Asian market movements, given hopes of easing trade tensions between the US and China, to Japan confirming that the country's economy contracted in the first quarter, we've got more international headlines in focus today. But first, let's start with the counters to watch on the SGX. Well, we have for you OCBC because the bank has made a 900 million Sing dollar conditional exit offer at 30 Singapore dollars and 15 cents per share for the 6.28% stake in Great Eastern it does not own, in a bid to delist the insurer. Now, the offer, which OCBC said on Friday was made at the request of Great Eastern, will resolve Great Eastern's 11-month suspension in share trading while providing its shareholders an exit at a fair and reasonable price. Now, we talked about this on Market View last Friday as well, but basically, if the exit offer is not approved, shareholders will have to vote on a bonus issue to increase the public float. So shares of OCBC up 0.553% at the close today. Now, aside from that, we're also tracking Capital Land Investment because Capital Land Investment has raised additional capital from new and existing institutional investors for its value-add lodging private fund. Now, this includes the acquisition of a prime mixed-use asset in Japan, valued at over 30 billion yen, which is around 267.2 million Sing dollars. Now, as a result, Capital Land Investments funds under management will also increase by around 470 million because it holds a stake of about 20% in the fund. So shares of Capital Land Investment down 0.391% on last check. Well, from the counters to watch right here in Singapore, I do want to set our sights on the broader Asian region because Asian equities rallied today, and that's on hopes that a fresh round of US-China trade talks will ease tension between the world economic superpowers. At the same time, investors were also cheered by this forecast-topping US jobs data. Now, if we look at the gains today, it extended a run-up across global markets in recent weeks. Why so? Fears about US President Donald Trump's tariff blitz that somewhat has subsided. Countries are also making deal with Washington. So at this point in time, all eyes are on London because top officials from China and the US, they're meeting for more negotiations aimed at preserving a fragile truce agreed last month that slashed at tit-for-tat levies, eye-watering tit-for-tat levies, if I may add. And the talks also come days after Trump and Chinese counterpart Xi Jinping held their first publicly announced telephone talks since Trump returned to the White House. And on top of that, there were also news that Beijing had on Saturday approved some applications for rare earth exports. Plane giant Boeing will also start sending commercial jets to China for the first time since April. So there was some optimism that both sides could make a breakthrough, and that boosted Asian markets today. If we look at the numbers, green across the board, Hong Kong up more than 1%, in fact, up some 1.5% at the close. So for now, eyes will turn to the Federal Reserve as it sort of decides whether to lower interest rates next week. Many economists, as we have known so far for now, they have warned that Trump's tariffs and his trade policy could reignite inflation, it could hit supply chains, it could drag on consumer sentiment. So how will the Fed act next week is certainly one to watch. But let's take you through how Asian markets ended the day. Australia's ASX 200, we don't have any numbers on this front because the ASX is closed for King's birthday. Nikkei 225 in Japan closed up 0.88%. South Korea's Kospi closed up 1.55%. Hong Kong's Hang Seng closed up 1.54%. And the Shanghai Composite closed up 0.43%. So a pretty positive day where Asia is concerned. Now, since we're on China, I do want to bring you some economic numbers out of the country because China's producer deflation deepened to its worst level in almost 2 years in May. Consumer prices also extended declines. Now, no surprises why that's the case because the Chinese economy is grappling with trade tensions, as we talked about earlier, as well as that prolonged housing downturn. So if we go by data from the National Bureau of Statistics out today, the Producer Price Index, or PPI, fell 3.3% in May from a year ago, worse than a 2.7% decline in April. It is also the deepest contraction in 22 months. So that compared with an estimated 3.2% fall in Reuters poll. So PPI fell 3.3%, estimation 3.2% fall in the Reuters poll. Uncertainties from tariff war with the U.S. weak consumption at home that have rattled sentiment and fueled expectations of more policy stimulus to combat the deflationary pressures. But what stood out to me this time around is also how, given how households are cautious about spending due to income pressures, some companies have also resorted to price discounts to boost sales, and that have prompted authorities to urge an end to the auto industry's bruising price wars. So that is what's going on in China. Well, aside from China, I do want to bring you more economic indicators out of Japan as well, because a revised estimate has confirmed that Japan's economy contracted in the first quarter. So, again, if we go by the country's Cabinet Office data, by the country's Cabinet Office, GDP shrank at an annual pace of 0.2% in the 3 months to March, which is a less severe drop than an initial estimate of a 0.7% decline. So economists, they had expected that initial figure to stand, but the improvement that we saw was driven by better than expected inventory and consumption figures. So inventories contributed 0.6 percentage point to growth, double the preliminary estimate, while personal consumption managed to eke out growth of 0.1% versus a prior flat reading. Now, how would you read into the numbers, right? The inventory gain basically is an indication of greater output, but it also points to unsold goods and components, which is a potential sign of weak demand. And meanwhile, business spending gained 1.1%, a little weaker than the first forecasts, while net exports, the main factor that's pushing the figures into the red, that posted a drag of 0.8 percentage point. So the revised data confirms that Japan's economy actually shrank before U.S. President Donald Trump, he amped up tariff pressure in April, and that also deepens uncertainty for policymakers. And it also supports the Bank of Japan's cautious stance. It keeps political pressure on Prime Minister Shigeru Ishiba ahead of a key election. So what will the BOJ do? Well, we know that the BOJ has slashed its growth forecast for this year at the last policy meeting. It is widely expected to maintain its wait-and-see stance when it next meets on the 17th of June. And finally, we want to wrap up with some corporate news before we let you go. And on my list today, news relating to Facebook's parent company, Meta. Why so? Because Meta Platforms is reportedly in talks to make a multi-billion-dollar investment into this AI startup called Scale AI. And that is, of course, according to sources familiar with the matter. So some of the people said the financing could exceed $10 billion in value, making it one of the largest private company funding events of all time. Now, sources, of course, said the terms of the deal are not finalized. It could still change. They could still change. And representatives for Scale and Meta declined to comment on the matter. But for some background, so Scale AI's customers include Microsoft and OpenAI. It provides data labeling services to help companies train machine learning models, and it has become a key beneficiary of the generative AI boom. So the startup was last valued at about $14 billion in 2024 in a funding round that included backing from Meta and Microsoft. And earlier this year, in fact, Bloomberg also reported that Scale was in talks for a tender offer that would value it at $25 billion. If the deal between Scale AI and Meta turns out to be true, this would be Meta's biggest ever external AI investment, as well as a rare move for the company. Because if we look at what Meta has done previously, it has before now mostly depended on its in-house research, plus a more open development strategy to make improvements in its AI technology. And that is in contrast with big tech peers, right? If we look at Microsoft, it has invested heavily, put in more than $13 billion into OpenAI. Likewise for Amazon and Alphabet as well, pouring their billions into rival Anthropic. Well, so lots going on in the world of business and finance. And what do you think of the headlines today? Well, let us know anytime at 8855-0893. Once again, the magic number, 8855-0893. And that's all that I have for you on Market View. I'm Chua Tian Tian.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.